Hi there and welcome to the Stock Club podcast, coming to you from the top floor of MyWallSt HQ here in Dublin, Ireland. In this week's episode, we're going to talk about Lyft's bumpy ride on the stock market, one of the best performing stocks to date in the MyWallSt app, and the two stocks we think would weather a future recession best. So we're going to start off today with some recent news from the past week. Rory, last time we were here, we were talking about Levi Strauss IPOing on the market. Who have we got this week?
Well, it's the one everyone's been talking about. It's the Pepsi to Uber's Coke. Lyft have IPO'd. The ride-sharing service based in the US and Canada went public last Friday. The stock reached a high of $86 on its IPO, valuing the company at around $26 billion. It's since tumbled back down to $70, officially entering a bear market on its second day as a public company. It's recovered a little bit, but I think it's going to open up and down today. So I think the thing about Lyft, I think, is, first of all, I'm amazingly impressed they even got to this point. For a long time, they were definitely the second fiddle. Uber was totally dominant, and very much thanks to Uber and some of the mistakes they made back in early 2016, especially their CEO, Lyft managed to kind of get a lot more market share. People kind of started to see Lyft as like the good guys of ride sharing. You know, they're very pink and they claim to be very socially conscious, but I don't actually think that's true at all. There's still some stories pretty much on a monthly basis about them paying drivers terribly, cutting their wages. Just in January, they blocked a bill that was going to happen in New York where they were going to bring their wages up to the minimum wage, the drivers' wages up to the minimum wage. And what's important to remember is that the reason that this is all happening is basically because of us. Ride sharing is too cheap. I lived in London for a couple of months. The difference between an Uber and a taxi in London is so big, there's no way that these companies could be making money, and therefore there's no way they can pay the drivers properly. So really, when you take a ride sharing, you are being paid to take that trip by the likes of Uber and Lyft and their drivers. So I mean, the long-term story might be that there's autonomous vehicles and that drivers are eliminated, and then the companies can become actually profitable. But it's a long, long way away. So it's a strange, like at $26 billion, I think it's a crazy price tag.
Have they raised that in their documentation that there's a longer term strategy for autonomous driving lifts?
Well, it's all in the background.
Yeah.
That would mean that they would fire an awful lot of people, and that wouldn't be very good press either. But like, they are working with Waymo on autonomous vehicles. Just a few kind of differences between Uber and Lyft that I think are important to point out. Lyft are very focused on consumer transportation. So Uber has Uber Eats, they have a freight service, they have Uber helicopters, whereas Lyft is really focused on just getting people from point A to point B. That in some ways gives them more focus on their main task, but it also means they don't have the kind of revenue streams that Uber does. They haven't got the kind of diversification. Secondly, they're only based in the US and Canada, whereas Uber is in multiple markets around the world. Again, there's pros and cons to that. It means that they are, when someone gets off a plane on an international flight, the first thing they're going to do is open up their Uber app. They're not going to open their Lyft app because they know Lyft isn't available in those countries that aren't in the US or Canada. But it also means that they're letting Uber do an awful lot of the heavy lifting in terms of regulations, opening new markets, getting people into the ride-sharing mentality. And also, most drivers are not exclusive to one or the other. So, if Lyft pay a bit more or treat them a bit better, they can easily work for both companies.
Okay. It's from your analysis there, it's quite clear that they're the second fiddle to Uber. But do you think the bad performance of the stock so far on the market will have an effect on Uber's IPO later this year?
I think it'll probably get people to rethink going in on the first day anyway, which is something we always tell people not to do.
A $120 billion valuation is pretty spicy.
Yeah, it's very spicy, but then again, Uber is the big name in the space.
Yeah.
Just on a side note to this story, I'm just going to go off the rails a little bit. But in terms of treating your employees badly, there's a stock that we've been asked to put in the app, and an awful lot of times it's a public company and we haven't for lots of reasons. And that stock is WWE, the World Wrestling Federation or entertainment company. And just anyone who hasn't seen John Oliver's piece on the WWE that was out on last Sunday, you really should watch it. It's a good reason why you shouldn't invest in a company like them. And
tell us more.
I won't go too much into it because he does a really good job of breaking it down, but basically they don't treat their employees very well. And wrestlers have a very short lifespan post work there.
Really?
Yeah, it's pretty grim.
Wow.
And ironically, I will be at WrestleMania on Sunday.
What?
Wow.
Just
That turned
to
into
slide
kind
that
of fact or
Where's that?
fiction land.
Madison Square Garden? Or?
I think it's in the Met Stadium.
Oh, the Met Stadium.
But yeah, it's a long story. It's kind of a joke that went too far. But yeah, there'll be me and 13 of my friends will be in New York at WrestleMania.
I always pegged you as a wrestling fan,
I
Rory.
don't know what's going on. Actually, one of the guys has come up with a little book of the storylines to try and keep us all informed as to when we should cheer and when we should not. I don't know when I'm going to get to read it. It's like 19 pages.
Well, just get WWE for your PS4 or Xbox and spend the weekend studying
I'm
now.
flying out tomorrow.
Are you flying out tomorrow? Too late.
Bit late then.
That was a voyage. Thanks, Rory.
You're welcome.
So moving on from that then, I want to talk about Apple again. So last week, Apple had one of their trademark big events in the Steve Jobs Theatre in California. But instead of revealing a new iPhone or Mac as usual, they revealed a host of new services. So there was 4 kind of main announcements. There was Apple TV Plus, which is Apple's long-awaited entry into the streaming industry. There was Apple News Plus. There was Apple News Plus, which is kind of an overall of their current news app. They're going to have more than 300 magazine subscriptions for a subscription price of $9.99. There was the Apple Card, which is Apple's first credit card, a partnership with Goldman Sachs. And Tim Cook actually called this the most significant change in the credit card experience in 50 years. Understated as always. And then finally, the last big announcement I thought was the Apple Arcade. So kind of off the back of Google announcing Stadia, Apple have said that they're going to release this subscription service, gaming service, also in the fall. And users will have access to more than 100 games exclusive or new to Apple. There was no price mentioned for that, but it's going to launch in this autumn and in 150 countries. So, there's been a lot of talk over the last week about all these new services Apple have unveiled, and especially I think the Apple TV Plus. It's quite interesting. But what I want to talk about is, how this is indicative of Apple's massive move towards services. Towards the end of last year, there was a lot of worries about falling hardware sales at Apple. iPhone saturation. The most recent versions of the iPhone haven't really have anything different too. There's been kind of slow uptake on them, and then we saw in their fourth quarter report there in January that iPhone revenue was down 15% from the year previously. But this isn't new for Apple, or it's not unexpected for Apple. They've been long saying that services is going to be their new big industry. Services revenue was up 20% in the last quarter to hit 10.9 billion, which is incredible for just one arm of Apple's businesses. And I think what's most interesting is that the gross margin was nearly 63%. So massive margins in the service industry. Tim Cook also said in January, which ties in with this, I think, and I quote, "I believe if you zoom out into the future and you look back and you ask the question, what was Apple's greatest contribution to mankind, it will be about health. Not the iPhone, not the Mac, not any of these, groundbreaking things. He sees health, which will fall under that services arm, I imagine, as what is going to be the greatest contribution Apple has to mankind." So yeah, it's just kind of, I thought it was this announcement of all these massive kind of things with Apple's cash pile really indicates a huge move towards services.
But are they massive?
I think they're pretty big.
I've heard of them.
I just was like, I thought that was such a weird event because it was like, I didn't think they really announced anything new at all. It was like, it's Apple TV Plus, it's Apple News Plus. It was just like tiny little add-ons. Mm-hmm. And I mean, the gaming thing was interesting, but they didn't say anything about pricing. The card, it's just, they're basically doing what other card companies do in an Apple way.
Very funny thing about the card. So it'll be available on your phone with Apple Pay, but you can also order a physical card, which will be made of titanium, classic Apple. But what I thought was really funny was that you can't use the tap to pay with the card. So there'll be no tap to pay function. You'll have to put it into the machine, which I think is crazy.
Oh my goodness,
considering
it's crazy.
I don't think I've ever, or the last week I probably haven't put my card into the machine. I'm always just tapping it.
The other thing about cards is, the whole thing about cards is they can be cool, and Apple isn't really a cool company anymore. Like, are people going to be like that, like impressed when you take out a platinum Apple card?
Well, it's going to make your wallet heavier. Right?
Yes, it's absolutely.
So
I mean, crackers,
that is a bit banana, especially for men. I mean, everyone in this office, every guy in this office has a really lightweight, small, compact wallet, right?
Yeah.
So I want to go back to the statement that you just announced, which is that Apple are no longer cool.
Well, are they a cool company? Are they like trendy?
Well, you obviously don't think so.
I suppose maybe that event put a kind of sour taste in my mouth because it was just these like middle-aged men coming out and saying,
Oprah
we have
was there.
made the best X ever.
Reese
Like,
Witherspoon was there.
yeah, it was just a weird thing where they were panning around
Yeah.
all the celebrities
Yeah.
sitting in the front row.
No, look, totally. The celebrity thing threw me, and I'm the same as you guys. So the card and the arcade are just concepts for me.
Yeah.
The Apple News Plus, I did tune into. So that's them saying that they're going to add more than 300 magazine subscriptions for a monthly price of $9.99, right? And my initial reaction to that was, my interest is piqued. This means that I will have a kind of an amalgamated news service,
Yeah.
and I will maybe see content from magazines that I'm interested in but would never buy a hard copy of. And then I thought about it more deeply and also observed other people's reactions and realised that actually it was Apple taking control and homogenising news and presenting what they wanted in the world of
you go.
news in one app for another tenner a month.
Yeah.
And I was like, okay, I'm going to hold on this and I'm going to see what the service is like and see how the news is actually chosen and curated and what the element of control is like.
But you can't even test it out yet. It's not available to you
No,
yet.
not yet.
Can I just read out a really interesting tweet I thought was the best tweet of the week by far? It was by a guy called James Wang. And he wrote, "The most disturbing thing about Apple's event is that the services weren't created to solve unmet user needs, but rather to support Apple's financial model. It is a dangerous thing when management, consciously or not, serves Wall Street as its primary customer."
This is it. This is what I think people are kind of reflecting
Yeah.
on when you see the services and the control within them.
So maybe we don't have confidence in Apple's pivot.
Well, the question is Apple cool anymore? Well, cool is a kind of, I think, an amalgamation of aspirational and maybe scarcity. And I know the Michael Kors example is very, very far way away from Apple, but Kors lost its strategic advantage by not being exclusive, by having a Michael Kors bag shop in virtually every mall in the US, and lost what made them special. And if Apple, or if cool has a degree of scarcity,
Yeah.
well, I'm not so sure if having any Apple device is cool. I do think they're extremely, well designed and wonderful function, but they are ubiquitous. I just don't personally see Apple as cool anymore.
Yeah, I mean, I
There you
don't
have
see people wearing an Apple Watch and go, that's really cool.
Well, that was always
Sorry, Alejandro.
That
You're
was
going to
all-
offend some people in our
that
office.
was always problematic.
And also, like, Steven Spielberg, he's not cool. He's a great filmmaker, but he's not cool.
There
like.
is some major statements being made today.
Like, if they'd put, like, Jordan Peele up there or something,
We need to qualify what we believe cool is, I think.
Well,
I will decide.
You're not cool.
it was very old world Hollywood, maybe. If is that what you mean? Like, it was all these guys from maybe 10 years ago, 20 years ago, even.
When Apple put U2 and a U2 album on my phone, that was the end of them being
Rory, do you know something?
That's it,
You
Rory.
are completely correct.
Yeah.
I forgot that.
what's
Apple are no
happening?
longer cool and will never forgive them.
cool. They also talked a lot about the like Apple Music, when they had Apple Music, and they were like, it's going to be like human curated. Like, human curation to Apple is making sure there's a Coldplay song on every playlist. Like, that is
Well,
not
it's
cool.
funny. So humanly controlled and tightly curated is how they describe News Plus.
Dangerous.
Yeah.
Right, moving on then. So that was the recent news. We're going to go on then to the company we never talk about. So this is where we have a look at one of the companies in the MyWallSt app that maybe doesn't get as much attention as it deserves. Emmet, you're up this week. What company do you want to talk about?
I'm choosing one of our top performers. I think it's in our top 3 performers at the moment. It is the company formerly known as China Lodging Group,
Yeah.
which is now known as Huazhu.
Wazoo?
Named it.
Huazhu. Did I?
Nailed it. You nailed it.
Well, okay, so one
No
of the
one
reasons.
listening will know.
So Huazhu Hotel Group is a hotel management company in China, and we more commonly refer to it around here as China Lodgings. Anyway, before I discuss about Huazhu, I'd like to just zoom out and talk a little bit about China, which we've done many times on this podcast. But China is the world's #1 tourist destination. When you bring in Hong Kong and Macau, and the biggest segment of Chinese tourism is mainland domestic tourism. So we're starting to get a feel for the biggest country in the world is the biggest tourist destination in the world, and the biggest segment of Chinese tourism is mainland domestic tourism. And increasingly, Chinese have surplus spending money, time to travel, and they've a very good transportation system which is being used. So the kind of petri dish for a hotel company is primed in China.
Yeah.
So Chinese domestic tourism has been increasing at about 10% per year for the longest time, and it contributes about 4% of China's GDP, which is a huge $9 trillion. So it's a big ticket item. So with China Lodging, if I may call it by its old name for the time being, we're looking at one of the biggest hotel groups in the world. Now, I have an old piece of data where they were the fourth biggest hotel operator in the world, which they may have improved on since, but I couldn't get up-to-date figures. But about 2 weeks ago, the company reported their Q4 results, and they were extremely impressive. Revenue increased over 20% in the quarter to almost $400 million, which is way above the guide and the estimates that was out there. They added 214 new hotels, and on the big picture, the hotel network grew 13% year over year. They have 4,230 hotels. I mean, that is a lot of hotels.
Yeah.
And yet, it feels it's only scratching the tip of the iceberg. Revenue per available rooms, as we know, Rory, from our analysis of Marriott some time ago, is a key metric in the industry, and it rose 10%. The average daily rate increased almost 10%. So when you go to Huazhu.com, the only thing you might recognize, unless you actually speak standard Mandarin, is a few hotel logos, such as Novotel, Ibis, Mercure, which they own a stake in.
Yeah.
So really, it's a very, you can't, well, I couldn't go to the website and derive much. But if you go to the investor relations website, which if you Google any business that's listed with the name or with I or beside it, it should bring you to investor relations website. There is a deck in there, most recent deck, which has a lot of graphs, which I won't dive into, but they are all very reassuring that it's a business trending very much rapidly in the right direction with a huge market opportunity. And CEO Jenny Zhang called the results very strong in her conference call and said, at the end of 2018, our hotel pipeline was a record high of 1,105 hotels. Or in other words, 1/4 of the hotels that they have in operation, they have that many on the conveyor belt on the way into their network. So therefore, she said, we expect our hotel network expansion to further accelerate in 2019. And our hotel network expansion will be primarily driven by mid-scale hotel openings. So it's not appealing to the exclusive, it's appealing to the mass market.
It's very much middle market
it
class.
It is, exactly. So the everyday traveller, the normal business person, and of course families who are touring and travelling around mainland China. So in the year ahead, there'll be a gross opening of around 800 to 900 hotels in China. About 75% of the new hotels will be in their mid to upper scale brands, and they're going to close 200 underperforming hotels. So it's not a group afraid to shut the doors on the underperforming assets.
Yeah, and I think when you're talking about China, it's always important to mention how big China is. I was just looking there. There's 160 cities in China with a population over 1 million people.
Incredible.
Like, it's mind-blowing.
I was on the phone to people to make sure it was big, and they reassured me it's very, very big. So China is mind-blowingly large. My wife just got back from Beijing there the day before yesterday, and even just anecdotally, everything we know here in the Western world, if you live in New York or LA, California, Chicago, or even in Dublin, you have a frame of reference of what a crowd is. But there was an event in Tiananmen Square that Fionn was telling me about with 1 million people in the square, and not while she was there, but a year or two ago. And really, it is really mind blowing, like the scale of the country. And I believe that the Huazhu Hotel Group, despite my rickety pronunciation, is one is just going to slowly burn away. And it stays off, I think, most retail investors' radars because it's over there. It's completely isolated in China, where the rules of business are different and where the ability to analyse the business is a little bit more difficult. And I think, again, over the long term, it will make a very fine investment. Yeah,
so that's the Huazhu Group. And I was just... Sorry?
Do you want to hear a fact about how big China is?
Yeah.
It's my favourite big China fact.
It's huge.
It's really big. They built this dam about 10, 15 years ago called the Three Gorge Dam, right? It's the biggest dam in the world. And in order to start it up, they had to flood some land and move people away. There was 13 cities flooded by that dam.
Yeah. That's actually that's a very good example, and I read about this, and it was a thorny and sad story because an absolutely mind-blowing number of people were displaced, and I think now I'm really straying into waters where I shouldn't, but I think the Chinese government are quite good at relocating families, and what I mean by good is they want families to be not just relocated but re-employed and kind of redeployed their skills. But I'm not saying that it's done in sympathy of the unsettled desires. I think it's get out of the way, we're coming.
Yeah, so that's the Huazhu Group. It's actually nearly a 4-bagger in our app. I was just checking there. It's the 4th best performing stock we have. Speaking of stocks in the MyWallSt app, we've a new stock of the month added this week on Monday. It's a SaaS company that's well positioned to weather a downturn because of its extremely sticky and diversified product. It has some big clients like Airbnb and Netflix on its books, so you can read that full report in the MyWallSt app now. Rory, we're adding a new stock to the app this Monday coming as well.
That's right. It's one that Emmet really likes a lot.
Yeah, I'm a fan. I think long-time listeners will be good. Will take a good guess at what it is.
Yeah, exactly. I was just going to say.
I mean, just thinking of Apple's subscription business as unveiled there in March, it plays into that mega trend of subscription services and transcends the digital world into real world.
So you can read that full report on Monday. Maeve.
So next up we have Jargon Busters, and we know how this works. So we've asked you guys, our listeners, to send us things that you don't fully understand in the industry or phrases that might be a little difficult to comprehend. We have a number of things that were sent in by you today, so thanks very much. We're starting with something that I don't, I'm going to be honest, I'm not familiar with, I don't fully have a grasp on, and that is something called an inverted yield curve. And the question is, what is an inverted yield curve, and why is it used as a signal for a recession?
I'll take that one.
Okay.
A yield curve is basically the yield that you get based on how long you're putting money away for in terms of lending money to people. So typically, if someone's buying a bond, a US bond, they're going to get a smaller interest rate on a 3-month bond than they are, say, get on a 10-year bond, because the longer you're putting money away, the more interest you expect to receive. And what happens sometimes is that inverts, that you're actually, the price for a short-term bond is actually higher than a 10-year bond, which is strange. And it basically, it is a harbinger that the mood is souring in the short term, that things are going to change soon, or that things are going to go different. It is typically happens before a recession, but just because it happens doesn't mean there's a recession happening, and it doesn't mean it's going to happen right away.
And have we recently seen inverted?
Yeah, it happened.
So that's why it's topical.
Last week, yeah. That's why people are talking about it at the moment.
Okay, great. The next question that we were asked is from a well-known contact of ours, Colin, who is, I think, currently studying for some exams at the moment, so best of luck, Colin. It's basically asking us about the SaaS industry and how do companies within SaaS differ from each other. So what's the differentiation between, I suppose he's talking about the SaaS companies that we have in the MyWallSt app, because we have a number of them.
Yeah, we have loads of them.
Yeah. So SaaS, software as a
service.
As a service. What's the difference there?
Between the companies, there's loads of differences. They all do lots of different things. SaaS is a kind of catch-all term for any business that's selling you software on a month-by-month, basically subscription basis. If you think about how most people used to use Microsoft Word and Microsoft Excel, was that you'd buy a disk with a license key on it, and you'd own the license to that software forever. And that
I remember those days.
Yeah.
And that was a one-time purchase that you then have forever. That's all. That model has gone totally out the window in the last few years with the emergence of the cloud, and businesses from Intuit to Microsoft to Autodesk to Adobe with what's the Photoshop with Photoshop have switched over to a subscription model where you are renting the software.
Cloud subscription, yeah.
Yeah, and typically what happens is you pay per person using it on a monthly basis, and it's very easy to expand. So if your business is growing fast, you can have 200 users one month and 500 users the next month, and it's literally like turning a switch on and off. So
cuts down on piracy a lot too, I would say. Well, it cuts it out.
Yeah, well, I'm sure there's pirates will always get their hands on something somehow, but it definitely cuts it down an awful lot.
Yeah. So that's the industry.
That's the industry. So, there's so many different companies that would be considered SaaS companies today. Atlassian, one that we use with Jira, we pay on a monthly basis to use that software. Viva Systems is a SaaS company for the life science industry with all their products, Vault and so forth. I'm sure we've loads of SaaS companies. Anymore. Just off the top of our heads.
Twilio, just loads of them.
And is there kind of differentiators even in the ones that we have in the app? Is there separate sectors or things that make them stand alone in groups? I think that's what Colin is trying to get at.
Well, there's also platform as a service, which would be, as I said, instead of using software, you're actually on someone's platform, like Salesforce would be considered a platform as a service. There's infrastructure as a service, so Amazon Web Services is a cloud infrastructure that you're renting off Amazon, so they're providing a service to you to use that. That infrastructure.
Well, we are running a software as a service company in its, I suppose, most stripped down version, and I suppose to Colin's question, he could probably draw a line between B2B software and B2C, or business to business and business to consumer SaaS. I suppose the B2C example that just jumps to my mind at the moment is recently acquired MindBody. Well, actually, it's B2B2C. It's business to consumer. They sit in the middle. But a way of assessing, I guess, for Colin, a way of assessing the SaaS companies is first think, has he used that service indirectly or directly? And it mightn't be likely that he's touched Atlassian's software products, and then he might rely on someone like us to say they're great, or he might have used Airbnb or Uber and knows therefore that the communication mechanism inside is powered by Twilio and can kind of get a feel for what they're doing. But B2B SaaS companies usually derive bigger ticket sales from fewer customers, and then B2C have smaller ticket sales to many more customers.
Okay. That was helpful. Hope that helps, Colin. We have one more for today, and it's from another long-time user and someone who we know, Eddie. Thanks for this. It's not exactly something that we're going to bust from a jargon perspective, but it is an outline, Emmet, which I know customers are very interested in, on your investment in Netflix, and I suppose the journey that brought you to that buy.
Sure. Well, pardon me if I'm repeating this story. I think I have already.
I've heard it once or twice.
God.
But a good story.
This one again.
A good story is, the shelf life
Netflix
of
again.
Well, my investment in Netflix is predicated on the observation. I was a Dell shareholder in the mid-90s, and I kind of had missed the bull run where Dell had grown dozens and hundreds fold even, and probably made a decent return on Dell. But what I realized at the end of the decade, almost last week of 1999, that Dell had grown 1,600 fold in that decade. And I was a young investor and, did back of the envelope calculations about $1,000 10 years ago would have turned into 1.6 million. And so forth, $2,000 into 3.2 million. And really, like, Dell, for a small number of people, augmented their lives, their wealth. It was for those who had the foresight in 1990 to say the home computer is going to be a big thing, as it was in the 1990s. And it took a lot of foresight. It took a lot of patience. It took a lot of moments of truth, because there are multiple times in the 1990s where Dell stock fell 40% or more in the space of a couple of months. But when you zoom out to the 10-year picture, it's the hockey stick curve. And that particular Dell story completely captivated my thinking.
Sure.
And probably was one of the most interesting analyses I've ever run on a company, because I really, really wanted to find the next Dell. And in order to do so, you have to go back to the first week of January 1990 and look at what Dell had. I had a passionate founder, who was Michael Dell. It had a product that was very future relevant on the front of the wave. It was catching a wave. It was building a name for itself in an emerging industry. And lots of other attributes. And we have spoken about those attributes on many, many times here in this podcast. And those attributes are what Rory James the team and I look at when we're finding the next best thing. I mean, when I invest my money, I in part, I'm thinking I'm looking for the next Dell. Like, that is, to this day, is still a motivating, I suppose, a sponsoring thought when I buy a stock. And that comes with knowing that they are in a future relevant industry and I'm going to invest in this for 10 years at least. Netflix so happened to be one of the ones I called right and held for the longest period of time. So if we transpose what I learned about Dell to Netflix, it had a passionate founding CEO in Reed Hastings. It had a future relevant business model. At the time I bought, they were posting DVDs, I think, in 5 states. And they were very, very small, which Dell was at the start of 1990. And I guess it was a mixture. Look, as when preparation meets opportunity, and I was lucky. So that is my story of Netflix. I sold quite a few of them along the way, but I kept more than I sold, and that's possibly one of the best things I never sold in my life.
Okay. Well, we all said that we'd heard you tell that story before, but that was a good rendition.
Yeah, it was. I really like the comparison to Dell. It's nice to have that anchor in your mind of that company you saw having success and going forward, looking for it again and again, and never selling.
Yeah, exactly, never selling.
Okay. Eddie, hope you enjoyed that, and thanks for asking us to talk about it again. That's Jargon Buster for this week. We had 3 items. Like I mentioned, we had a lot more contributions when we asked for your ideas about what to include on email and Twitter, so we're going to come back to them in the next pod. And we're moving on to elevator pitch. So the theme for this week's elevator pitch is recession-ready stocks. That's worth noting that it's linked to the recent stock of the month that went live in the app on Monday, if you want to go and check out what that is. And Emmet and Rory, stock each. Let's get into the lift.
60 seconds.
Do you want to go first?
Okay. So I'm going to go with, show me the timer, here we go, American Tower. And American Tower is, again, a stock we don't talk about too much. It's a REIT, a real estate investment trust. And I guess the key to finding a stock that will survive and thrive through a recession or downturn over the long term is a business that won't get disrupted. So American Tower has a massive barrier to entry, and that barrier to entry is a portfolio of 170,000 cellular towers, which it leases out to the likes of AT&T and Verizon and all the other mobile telecom giants around the world. They have towers and rooftop solutions in 17 countries, so they are geographically diversified. They are infrastructurally diversified, and 5G is just bubbling up. 5G is starting a mega rollout this year. It's being switched on in certain countries, and I see a bit like getting your hair cut. You don't stop doing it in a recession. Mobile networks will not stop renting tower and roof space in a recession.
60 seconds.
Bang on.
What was that?
Close enough.
Okay.
I started 2 seconds in.
So you're only 2
No, I
seconds
watched
over.
the clock. That was good.
Okay, so
Go.
So I was thinking about recession-ready stocks is weird because, well, first of all, people talk about recession-proof stocks a lot, and I don't actually think there's such a thing because every recession is different and industries are affected in different ways. Like you said, maybe if you've read the stock of the month report, I think enterprise software as a group is a good place to be in tough times because they actually save companies money. But the company I'm going to go for is Costco, which is one of the best run businesses in the world, in my view. They are the anti-Walmart. They're a business that likes to deliver value while also treating their employees well and being socially conscious. And if you look just back to the 2009 financial crisis as an example, Costco stock dropped from peak to trough 37% in that time, which obviously was very painful. But if you look at the way it's rebounded, it is up 5.5-fold since then versus the S&P, which is tripled, which is also very good. So basically the pitch is during economic hardship, people will dine in more, they'll buy in bulk and cook more. And despite the tough environment, they're still ranking up comp sales of 9-10%, and they have a membership service with 90% renewal rates.
Cool.
Right. There we go. Pitches are in, James. What do you think?
I think Costco. I like that pitch. I think a company like that surviving right now, when times are good against the likes of Amazon and stuff, is impressive enough. So yeah, I would have confidence in Costco.
I think I was probably going to go for Costco this week too. Yeah.
And truth told, so would I.
Yes.
Do we want to wave in at our studio owner and sound engineer?
Oh, well, he just gave us a thumbs
Just
up. I don't
agree.
know.
Yes, the answer is
The answer
yes.
is yes.
likes
Giles
both of
says yes.
Okay,
Clean
excellent.
sweep.
Right, that's it.
Yeah.
Sure. Okay, so we'll wrap there. Like I mentioned in the Jargon Buster segment, we really do want to hear what you guys want us to talk about. So always get in touch if you have a suggestion for that segment or for anything else. You can find us on Twitter or you can email us directly at pod@mywallstreet.com. That's pod@mywallst.com. If you enjoyed listening to us today, we really would appreciate a review on iTunes or whatever podcast player you use. It helps us get the podcast to more listeners. Thanks for listening. We'll see you in 2 weeks, and as always, happy investing.